Madam President, I rise this afternoon because while we were away for our Thanksgiving break, there were some very important developments on an important piece of legislation that we passed earlier this year, the CARES Act. And specifically what I'm referring to is the decision that was made by the Treasury Secretary, Secretary Mnuchin, to not extend the 13.3 lending facilities that we dramatically expanded in the CARES Act. And by way of reminder, let me just summarize these facilities. When the economy first began to close down back in March, April, one of the things that started to happen was a collapse of our credit markets. I'll get into that in a little bit. In response to that, we in Congress passed the CARES Act, which, among other things, appropriated just under $500 billion, $500 billion, for the for the Treasury to use to capitalize special purpose vehicles, which would be set up as entities from which the Federal Reserve would lend money, buy securities, provide liquidity to the marketplace. Those were scheduled to end, those facilities, by the end of the year. And in keeping with the written statute and certainly the intent of Congress, Secretary Mnuchin announced that these programs will in fact end as they're supposed to. I commend him for making the right decision. And I commend Chairman Powell for agreeing to a subsequent request from the Treasury Secretary to return the unused money. As it happened, the program, the concept worked so well that the mere announcement and the mere creation of the capability on the part of the Fed to provide this liquidity was enough to restore functioning capital markets. So it was an extraordinary amount of trust that we put in both Treasury Secretary Mnuchin and Chairman Powell, giving them extremely powerful, unprecedented emergency and temporary tools. And I commend them both for working together with those tools, for achieving the intended purpose, and for putting them away once the purpose had been achieved. Now, some of our Democratic colleagues have been extremely critical of this decision on the part of Secretary Mnuchin not to extend these programs. And so I want to address some of the arguments and why Secretary Mnuchin, in fact, did exactly the right thing. And let's go back and take a hard look at what we were facing in March of 2000. Unprecedented turmoil in the credit markets that were threatening the ability of virtually every business, state, and municipality in America to obtain credit. A real threat to the financial plumbing, so to speak, of our entire economy. Credit markets were on the verge of shutting down. There was a mass flight of investors out of any kind of financial instrument and into cash. People were trying to sell everything they had. Prices were dropping like in a free fall. In many instances, there was no buyer. There was no price at which one could sell an investment. Of course, that meant that a borrower couldn't sell a bond, couldn't issue commercial paper. This was the freeze-up in our financial markets that we were right on the verge of, and very desperately afraid that if this happened, if our financial markets came to a grinding halt, and you could neither borrow nor lend, either in the capital markets or in the private lending markets of banks, then that would almost assuredly accelerate the downward spiral of our economy and could lead to even a severe depression that could last potentially a very long time. You don't have to take my word for it. One of the a very well-stated summary of what was happening comes from Kent Heitshaw, who was the Deputy Assistant Director for Financial Stability at the Federal Reserve. So a senior executive at the Federal Reserve who, in his testimony before the Congressional Oversight Committee, here's what he had to say, and I quote, "The conditions that prevailed during March were unprecedented, far worse than during the onset of the financial crisis in late 2008 or even in the days after 9/11, when the municipal bond market was briefly closed. Interest rates soared. Mutual fund investors pulled over $41 billion of assets out of the market in less than 3 weeks, and market functioning deteriorated to the point that buyers and sellers had difficulty determining prices. Ultimately, this meant that state and local governments were effectively unable to borrow, with most new issues canceled for lack of investor demand. Madam President, that was the problem that Congress was seeking to address. A complete freezing up of our capital markets, the inability to borrow or lend. That is the lifeblood of business, which is the source of employment in this country. If we hadn't done anything at that moment, who knows how many millions or more Americans would have lost their jobs, how many more millions of businesses would have gone under. The economic devastation is very, very hard to imagine had we not done anything. Fortunately, we did do something. Congress decided that that problem could be fixed by providing enough liquidity until the crisis passed. We'd make sure that operations of this liquidity exercise would extend no later than the end of 2020. And that's what we did in the CARES Act. And just last week, every Republican member of the Senate Banking Committee sent a letter to Secretary Mnuchin and Secretary Powell reaffirming that that was Congress's intent, a short-term, temporary facility to restore functioning private markets. Well, I am pleased to be able to report that these emergency facilities absolutely achieved the intended purpose. Again, the purpose to stabilize our credit markets, restore the normal flow of credit to borrowers, and allow private capital to continue to resume funding our economy. It worked even better than we had hoped. Markets didn't just improve. We didn't just see liquidity return. We saw record volumes of new debt issuance, new investor interest, municipal bonds, investment-grade corporate bonds, high-yield corporate bonds. Volumes were off the chart in response to these facilities. Spreads, credit spreads at which these instruments were issued were very tight. Interest rates are near record low. On the banking side, regional banks reported that their commercial borrowers drew down lines of credit so that they had the cash they would need to get through a very difficult period. In fact, many of them have been able to start paying that cash back. And according to various surveys of businesses across America, unmet demand for credit among credit-worthy borrowers is almost non-existent. In other words, credit-worthy corporate borrowers, businesses large and small in America, if their credit is strong, they are able to access the facilities they need, the credit they need. That's exactly what we had hoped would happen by virtue of setting up these facilities. Despite that, some have said that we can't end these facilities. They're called the 13(3) facilities because that's a section of existing law under which the Fed is authorized to conduct these activities. And people suggested, well, you can't end these because the markets depend on them. For their normal, smooth functioning, the markets now depend on these facilities. That was what we were told, Madam President, as a reason why the Treasury had to extend these, presumably indefinitely. But in fact, what we saw proved that the naysayers were completely wrong. In fact, it was on November 19th that Treasury Secretary Mnuchin announced that he would not be extending these programs. And how did these financial markets respond? With a yawn. There was no adverse developments whatsoever. They continued their smooth, liquid functioning because by November 19th, in fact, many months prior to November 19th, the markets had recovered on their own. They were functioning on their own. They were no longer in need of this fallback facility that we created because we did need it back in March. Equity markets hit all-time record highs, municipal debt, corporate debt, volumes very high, yields low, the market's functioning very, very smoothly. So clearly, those of us who were advocating that we actually follow the law and end these programs were right that the markets were not actually depending on them anymore. Other people said, well, you shouldn't end the 13.3 facilities for other reasons, one of which was, who knows what risks may be out there, what bad things might be on the horizon for our economy, which would cause us to want to have these facilities. Madam President, that's a very bad reason for giving indefinite lending authority to the Fed to make direct loans to businesses in America. First of all, there's never been a day in the history of the Republic that you couldn't imagine some bad thing that could possibly happen on the horizon. That is no reason to create a taxpayer-sponsored backstop for all financial activity. None whatsoever. And sure, a bad thing could happen. Nobody knows. If it does, there's an answer. If such a disaster were to occur in the future that our financial markets were in danger once again of freezing up, then the Fed and Treasury should come back to Congress and ask for whatever authority they think is appropriate for those circumstances. And based on what we did in March, Congress is quite likely to respond by granting the tools necessary to deal with whatever hypothetical crisis may emerge down the road. Others of our friends say, well, you can't get rid of these facilities, you can't terminate these facilities because there are industries that are failing in America. Well, let me be clear, it's true. There are industries that are in a world of hurt. We know who they are. The travel industry, much of the tourism, hospitality generally, hotels, restaurants, a lot of the entertainment venues, devastated like we've never seen it before. That is a true fact. And I think you can make a strong argument that Congress ought to do something to respond to the circumstances that these folks find themselves in through no fault of their own. They're in the situation they're in because, in many cases, their governors closed their states. And in others, it's because people are just prudently concerned about being in a crowded setting. So there's a problem there, there's a challenge, and we may very well decide we want to address it. But having the Federal Reserve lending money to fundamentally insolvent companies, that's not the role of these facilities. It never was. It's not contemplated in the underlying 13.3 statutes, and it's not in the CARES Act. That's not what this program, what these facilities were meant to address. So let's be clear about what the advocates for continuing these 13.3 facilities are really all about. What's going on here is they want these programs, this massive, massive amount of money that's at the discretion of the Fed and the Treasury to lend. They want to use political pressure on the Fed and the Treasury to lend these facilities to favored political constituencies at terms that they find appealing or attractive, depending on their circumstances. This is exactly the opposite of what a central bank should be doing. Capitulating to political pressure to lend to preferred constituents at whatever terms the politics dictate. There couldn't be anything further from the role that the central bank ought to be playing. And so to my colleagues who are advocating that we do exactly that with these 13.3 facilities, I couldn't disagree more. If we want to be in the business of picking industries or sectors and subsidizing them or giving them money or treating them in some unusual way, we can have that discussion. But that's fiscal policy. That's a decision that ultimately needs to be made by the politically accountable branches of government, the Congress and the President, not the central bank that is supposed to be independent and apolitical. The fact is, Madam President, I think we deserve a congratulations. Even more so, I think the Treasury Secretary and the Chairman of the Fed deserve a congratulations for setting up the facilities that made it possible for our economy to begin a record recovery from a very, very deep trough that we hit in the late spring of last year. Now, we all know that we're not at the end goal. We are not back to full employment yet. We have, as I said before, many companies that are in deep trouble, many that have gone out of business altogether. We've got a lot of problems. and we need to deal with them. But we do know this recovery has been occurring at a faster pace than anyone projected. Most economists, including at the Fed, thought that we'd be lucky if the unemployment rate dipped below 10% by the end of this year. It was at 6.9% at the end of October. So we've got a long way to go before we get back to the barely above 3% unemployment rate that we were enjoying before this pandemic hit. And by all means, we need to stay at it till we get there. But we won't do that by turning the Fed into the allocator of credit based on political demands. That would be a very, very bad idea. It would lead to worse economic outcomes, all kinds of distortions, and it would erode the independence of the Fed. So, Madam President, as I say, I want to congratulate and commend the Treasury Secretary for making the right decision, the Chairman of the Federal Reserve for returning the unspent money. These programs were remarkably successful. They have served their purpose. Their purpose is now behind us, and we need to continue the policies that will allow us to have the economic recovery we need without these programs continuing. And I yield the floor.